$309. That is the number Bank of America put in writing, signed by Michael Widmer, head of metals research, published at the start of this year and still standing unrevised. The mainstream press spent 2 weeks trying to explain it away as a tail risk scenario, a ceiling case, a once-in-a-generation extreme. Widmer did not walk it back. He stood behind it. Here is why that number matters right now, today, not historically. Silver is sitting near $90 per ounce. The gold-to-silver ratio is still above 50-1. The COMEX registered inventory just confirmed 86.13 million ounces of deliverable silver against 10,526 contracts. Standing for March delivery, that is 52.63 million ounces of physical demand arriving at a vault with a 6-to-1 paper-to-registered ratio behind it. The tension in this video is not whether BofA is right. The tension is whether the physical market gives the paper market enough time to find out. I am going to show you exactly what the BofA forecast actually says versus how it is being reported, why the COMEX March delivery window is the live pressure event happening right now, what China's Ministry of Commerce did on January 1st that changes the supply picture for the rest of the year, and what the one number buried inside the BofA report tells you that the headline number does not. This channel exists because the paper price and the physical price are pricing two different realities right now. The mainstream covers the paper. We cover both. That gap between the two is precisely where the next major repricing event is being built, and it is being built in the dark while CNBC runs its interest rate segment. If that is why you are here, drop COMEXOG in the comments. That is it, just so I know you are paying attention. There is a specific number inside the BofA report that the mainstream press buried completely, not the 309, the other number. I am coming back to it after I walk you through the COMEX delivery mechanics, because without that context it reads like a footnote. It is not a footnote. Now here is the institutional framework you need to understand before any of the data lands properly. Bank of America does not publish a $309 scenario to help retail investors position themselves early. Large institutions publish price range forecasts that justify the positions they are already building and the derivatives books they are already running. Widmer's forecast is mathematically anchored in the gold-to-silver ratio, with gold near $5,000. Applying the 2011 ratio low of 32-1 puts silver at 135. That is the base case. Apply the 1980 Hunt Brothers extreme of 14-1 and the math produces 309. Widmer himself stated in the Kitco interview that the price could cap at 309, not floor at it. The mainstream press inverted that language. They turned a ceiling scenario into a floor headline. Watch who benefits when retail money chases paper silver on the back of a misread institutional forecast. And that January 29th crash from $121.88 to $75 in under 30 hours has never received an official explanation. No CME regulatory filing, no volume breakdown, no statement from any named institution. I am going to walk through what the data around it tells us. And I will come back to why the silence on that explanation matters more than any statement would that covers the institutional framing. What happened on the ground is a different story entirely. Now let me show you the COMEX delivery mechanics, because this is the verified data underneath the BofA headline. CME official depository statistics dated February 11, 2026, confirmed a single-day negative adjustment of 3,256,882 ounces from the registered category. Total registered silver hit 98,138,005 ounces that day, breaking below 100 million ounces for the first time. That level has continued falling. By late February, registered inventory confirmed at 86.13 million ounces. February 2026 delivered 5,036 contracts, 25.18 million ounces, the highest February delivery volume in modern COMEX history. On January 29th alone, first notice day, 1,881 contracts demanded physical, that is 37.3%. Of the entire month's deliveries on a single day, industrial users are not waiting for settlement. They are pulling metal the moment the window opens. The number looks stable to a passive observer. It is not stable. It is being consumed in real time, and the consumption rate is accelerating. Now here is the number I told you the BofA report buried. The base case, $135 silver, requires only a compression of the gold-to-silver ratio from 59-1 down to 32-1. That is the 2011 level. That is not an extreme. that is a prior cycle normal, the 309 number, requires the 1980 Hunt Brothers extreme of 14:1. But at the current registered drain rate and March delivery pace, the COMEX does not need a Hunt Brothers event to have a delivery problem. It needs the ratio to stay elevated long enough for the registered inventory to hit 50 million ounces at the current burn rate. That conversation starts before year-end. Most people watching this have probably never had the paper-to-physical ratio explained in terms that actually mean something, so let me stop for 1 second. Registered silver is the only metal that can legally fulfill a futures delivery. Eligible silver in the same vault cannot. It is like a restaurant that has food in the back storeroom, and food on plates being carried to tables. The plates are registered. The storeroom is eligible. Right now there are 6 tickets written for every plate on the floor. That is the March delivery window. What I am about to show you in the China data is why new plates are not coming from the kitchen. Right now my read is that this is a structural supply failure building across multiple jurisdictions simultaneously, not a single market speculative event. But there is one piece of Shanghai data that either confirms that read or complicates it. Hold that tension while we go through the China piece, because if it reads the way I think it does, this is a different conversation by the end. China's Ministry of Commerce published an official announcement on January 1, 2026, designating exactly 44 companies authorized to export silver for the 2026 to 2027 period. This is official data, not analyst commentary, not social media. The Chinese Ministry of Commerce on record. Confirmed by Reuters, exporters must hold a government-issued license and maintain annual production capacity of at least 80 tons. That requirement eliminates hundreds of smaller refiners who have supplied Western industrial users for years. China controls between 60 and 70% of the world's refined silver supply, 44. Approved exporters. That is the new ceiling on what the Western market can access from the dominant global refining complex. If you have made it this far, you already understand more about this market structure than 90% of the people reacting to the headlines. Stay with me, because the Shanghai number closes the loop. The Shanghai Gold Exchange inventory hit 10.24 million ounces in February 2026, the lowest level since 2015. Shanghai prices were simultaneously running $7 to $15 above Western spot for multiple consecutive sessions. That premium is not arbitrage noise. That is Eastern industrial buyers outbidding Western paper price discovery in real time. Eastern physical demand is setting a price floor that Western futures markets are failing to reflect. That is the data point that confirms the structural read. This is not a speculative spike on one exchange. The drain is running simultaneously at COMEX and Shanghai. Both systems are losing registered inventory at the same time. The U.S. government confirmed silver's changed status in November 2025 by officially adding it to the critical minerals list, and Fresnillo, the world's largest primary silver miner, published official guidance cutting 2026 output to 42 to 46.5 million ounces, down from a prior forecast of 45 to 51 million ounces. That guidance cut is official, from company filings. The production floor just dropped. Some alternative market watchers are circulating claims of a coordinated force majeure export moratorium between Mexico and Peru. That specific claim is unverified. No official government announcement has been confirmed from either country. What is verified through industry analysis is that Mexican supply chains face documented security disruption in major mining states. The coordinated bilateral ban is an unconfirmed report and should be treated as such. Now here is the honest case against everything I just showed you, because if you only hear the bull case, you are being sold something. The delay case is real and it is substantial. Silver crashed 36% in under 30 hours on January 29th. That is not a paper manipulation story alone. That is also a leverage flush with real consequences for traders who were long. The Federal Reserve's hawkish trajectory under Kevin Warsh is a genuine macro headwind. For all commodities, silver recycling is at a 12-year high and rising. The Silver Institute projects above 200 million ounces of scrap recovery in 2026. Recession scenarios historically cut industrial demand by 30 to 40%, and silver fell from $21 to $9 in 2008. But here is the thing the delay case cannot resolve. 40 million ounces of additional scrap does not close a 95 million ounce structural deficit. It narrows it. The cumulative shortfall since 2021 has exceeded 820 million ounces. That is a number the recycling recovery cannot reverse in a single cycle. The January 29th crash has also now been explained by the market itself. Managed money positioning collapsed 77.72% year-over-year, from 54,415 contracts in February 2025 to 12,121 contracts in February 2026. The speculative overhang was flushed. What remains in the delivery queue is industrial demand, not speculation. And the January 29th silence I told you to hold? That silence is the answer. No institution files a regulatory explanation for a move that was entirely organic. The absence of a filing is not exoneration. It is the shape of a system that does not yet have a framework to explain what structural delivery stress actually looks like when it starts. Algos can manufacture a paper price. Correction. They cannot manufacture new registered silver. Banks can run paper games through any delivery window they choose. They cannot reverse a 44-company ceiling on Chinese refined silver exports. Watch three numbers going into April. First, COMEX registered inventory every Monday. If it breaks below 75 million ounces before the May window opens, March pressure becomes May crisis. Second, the Shanghai premium. If it compresses back to $2 or $3, Eastern demand is easing. If it holds above $8, the drain is still running. Third, Fresnillo's first quarter output report against guidance. They set a floor of 42 million ounces for the full year. Watch whether they track that floor or miss it. Verify this yourself. Check CME official depository reports at cmegroup.com. Verify the China Ministry of Commerce 44-company silver export authorization through the Reuters January 1st report. Read the Silver Institute's 2026 World Silver Survey for the structural deficit data. Pull Fresnillo's official company guidance filings. The people who actually verify those sources do not need anyone to explain what is building here after the fact. Physical holders. The 820 million ounce cumulative deficit does not get solved by a Fed nomination or a margin hike. The fundamentals behind your position have not changed. Hold it. Futures traders. The March delivery window is live. The May contract is building behind it. Understand your paper exposure relative to the registered inventory number before the next first notice day arrives. This is education, not a signal. ETF investors. Understand the structural difference between a synthetic silver fund and a physically allocated trust before this delivery pressure cycle reaches its next peak. Not all silver paper is equal. Do your own research on how each fund actually holds its metal. Sideline watchers. The BofA 309 scenario does not require a Hunt Brothers event to be directionally relevant. At the current gold-to-silver ratio, the base case of 135 requires nothing more than a reversion to a prior bull market normal. You do not need the extreme to have a structural repricing well above current levels. Scenario 1, bullish. COMEX registered inventory falls below 70 million ounces before June, May delivery demand exceeds March, and the Shanghai premium holds above $8 through the second quarter. Silver reaches $122–150 by year-end. Probability, 30%. Scenario 2, neutral. Delivery pressure is absorbed. Recycling supply partially offsets the structural deficit. Macro headwinds hold silver in an $80 to $110 range through the second half. The ratio compresses slowly. Probability, 45%. Scenario 3, bearish. Recession materializes in the second half. Industrial demand drops sharply. The Fed tightens further. Paper silver unwinds with broader commodities. Silver retests $65 to $75. Probability, 25%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research. Always. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.